Services webinar, R&D Tax Credits for Manufacturers, Driving Growth Through Innovation, presented by experts from Sagemont Advisors. I'm Catherine Church, Vice President of CM Services. CM Services is proud to deliver this first ever webinar to manufacturer members of all its client partners. One of our core values is to collaborate to achieve great results. Delivering a webinar on an important topic that can both educate and potentially help manufacturer members of our client partners save money is one way we are delivering on that core value. Today, Sagemont Advisors has brought together 4 experts to deliver this important webinar topic. Tim Parrish is a licensed attorney based in Dallas, Texas, and the CEO of Sagemont. Prior to starting Sagemont, he co-led the tax credits practice at Ernst & Young, a Big 4 accounting firm. Since 2013, he's assisted thousands of clients with tax credits, saving billions of dollars for companies of all sizes. Tim earned his Bachelor of Arts from the University of Virginia and his JD from Pepperdine School of Law. Matt Davenport serves as Sagemont's Director of R&D Tax Credit Services. As the leader of Sagemont's R&D practice, Matt specializes in helping businesses identify, quantify, and substantiate complex tax credit and incentive opportunities. Susan Bennett is a CPA based in Houston, Texas, with over 35 years of experience on the R&D credit. Susan will focus today on how to successfully claim the credit for light and complex manufacturing companies, given her deep experience with tax court cases and IRS negotiations. Eugene Dinkellis serves as a senior account executive at Sagemont. With a knack for simplifying complex programs and a customer-centric approach, Eugene manages strategic partnerships and key relationships for Sagemont. So, Tim, I'm going to turn the controls over to you.
Thank you, CJ, and thank you everybody for joining us today. We're excited to give you an update on the research and development tax credit. There's a lot that's happened in the last few years, and in particular in the last 6 months or so. So today we'll give you an overview of our firm. We'll talk about R&D from both a 101 educational perspective and also give you key insights into how the credit applies to the manufacturing industry. We'll go through the legislative changes that happened last summer as part of the One Big Beautiful Bill Act. Susan is going to do a deep dive on the manufacturing industry and applicable case studies in the R&D space. And then we'll spend a few minutes talking about how to determine eligibility for the R&D credit, what our process is, and how to substantiate your credit. And finally, we'll leave some time for Q&A. So Sagemont is a firm that has both Big 4 attorneys and accountants. We specialize in tax incentives. We've been working on R&D tax credits over a few thousand studies, not just R&D credits, but incentives across the business life cycle. So we're guided by experience not only in the manufacturing space, but across multiple industries and many, many programs at the federal and state level. We take a very client-focused approach. So we want to make sure that everyone's on the same page regarding the materiality, the qualifications, and the calculation methodology. So we want your involvement, we want your sign-off, we want, in a lot of cases, even to work with your CPAs, and we'll talk through that as we get closer to the end of the presentation. And finally, the one guiding principle for us is that we seek to build long-term partnerships, not short-term transactions. So with that, we'll turn to the first polling question just to get a sense of who's in the audience. And so the first question is, what is your experience with the R&D credit? My business claims it every year. We may qualify, but my business doesn't claim it. I don't think we qualify, or unsure. Give you a couple seconds here to respond. Great. So it looks like we've got a mixed group here. Looks like there's some folks that are seasoned R&D credit claimers, some companies that may qualify, about 40%, but don't claim it. A few folks that aren't sure if they qualify. So it's great to be in front of a mixed group here. With that, I will turn it over to Matt to walk through an overview of the R&D tax credit. We'll talk through what qualifies, what kind of activities qualify, what kind of expenses are included in the calculation, and how the credit is calculated. Matt?
Fantastic. Thanks, Tim. So, at its core, right, the R&D tax credit is a federal income tax credit. The goal here is that it's a dollar for dollar reduction of tax liability. So this credit can be very, very powerful in supporting growing businesses that spark innovation, but really all businesses across the board. It's a direct reduction of your year-end tax liability, and it's ultimately just a portion of your spend that goes towards that. Now, it originally founded, or I guess written by Congress in the 80s, this credit has been around for almost 4 decades, a little over. So it's not new. This is something that all taxpayers should at least know about. It's something that you should be claiming on an annual basis, and it's really there to incentivize businesses to innovate and grow. In the early 80s, America was losing a lot of technical jobs to foreign countries, and to help put a stop to that and to help continuing the growth of America, Congress created this incentive, and it's changed a few times. It was actually made permanent in 2015, and then was sparked again by the One Big Beautiful Bill that Tim will go into a little bit later. But it's very powerful. Now, there's going to be this sort of incorrect assumption that research and development is white lab coats, or it requires some type of robotics or engineering, and that's just simply not true. Susan will go into some really great examples here in a little bit, but the idea that we want to stress throughout this webinar is almost all businesses have some form of R&D, and so you should keep your eyes open and your ears attuned to what can qualify here, because there's, in all likelihood, your manufacturing business is probably doing some form of R&D. Now, what generally qualifies? There's a lot. We'll hit some high notes here, but really on the product design and development side of the house, we're going to be looking for the iterative development of new prototypes and the development of new products. This starts from conceptualization and goes all the way through till you have a commercialized product that is ready for sale. There's also this idea of process improvements. This is going to be your business integrating new software, new technology into your production line. It could be a new piece of equipment that nobody really knows how to use, but you know the end result, and you know it will be an improvement to your overall throughput. It can also be the development and the process of creating new widgets or new prototypes. Now, prototyping, testing, and iteration is on here. That's going to be the big piece. It's really important to note that in most manufacturing facilities and on most manufacturing floors, all of you are probably participating in some form of prototyping, whether it be day to day or maybe a few times a month. Anytime that you are uncertain into what the result will be, maybe it's a contract that you're trying to win, maybe you're trying to help a client redesign a widget, there's going to be some form of R&D there, and you should be capturing that. And then there's the software development piece. So along with your manufacturing on a day-to-day basis, there's always the idea of how do we make this more efficient? How do we improve our process of throughput? A lot of companies have started leaning on software. The integration of that can be new control panels, that can be sensors, that can be a lot of different things. And it's important to note that can qualify towards the credit. Now, we'll go into more detail on this here in a minute, but there's really 4 areas of expense that we need to look at for the R&D tax credit. And The big one is going to be employee wages, but things that often go overlooked are raw materials. These are supply costs that are used up in the process of R&D. Third-party contractors that you bring in-house. This can be engineers, this can be designers. It could, honestly, it could be a mechanical engineer that's coming in to help throughput. As long as they're helping to improve the process or the product you're creating, there's a chance they could qualify. And then certain software costs, which that's really on the development of software. Now, the IRS prescribes what has been coined as the four-part test. This is what the IRS leans on when it evaluates whether a taxpayer qualifies for this credit or not. There's a lot of technicality here. I'm going to try to keep it high level. Something I would ask the audience to continue thinking about throughout this portion is how this might correlate to your day-to-day production cycles. So the big rule, the big one here is you have to be developing something new, and it has to be for a permitted purpose. So this could be a product, it could be a new process, it could be an invention, a new technique, or a formula, a few versions of other things that you are creating or improving to ultimately increase functionality, performance, quality, or reliability. And it's sort of broad, right? It's broad on purpose. So anytime you are developing a new product, a new widget, you're running a new product or a new widget, trying to improve the functionality of that product, trying to improve the throughput of your line, you are likely incurring some type of research costs. The second piece here is this idea of whatever you're doing from an R&D perspective, it has to be able to be tied back to principles of a hard science. This is the technological in nature requirement. This essentially just means that what you are developing has to correlate back to physics, a material science, biology, chemistry, software, something that is considered a hard science by the IRS. It can't be a psychological idea or concept or something that's more along those lines, managerial. Item number 3 here is vitally important. It's going to seem more technical than it really is. So the idea here is that at the outset of every development engagement, you have to be eliminating some form of uncertainty. And all that means is when you're going through your iterative process, if you know the end result, then it's probably not research. Now, if you don't know the end result, but you know ultimately what you want to achieve, that is the uncertainty that you're eliminating throughout this process. So an example of this could be navigating outcomes, right? Conflicting design constraints, overcoming limitations, determining if we can build this item. Many of you may do some form of contract manufacturing. When a client brings you a widget or a concept, and you have to sit with your team and decide, can we make this? From that point forward, up until you have a prototyped, ready for commercialization product that's going to be sold and mass produced, there's research ongoing. In bullet point 4, this is really where the consultants come in, and Susan and I will help provide some more examples of this later, but we have to be able to document and prove to the IRS that you are actually undertaking a process of experimentation. You probably are, and in all likelihood, your team probably does this almost daily. We have to be able to document that and actually provide the IRS with resources that prove that you are taking on these projects with some form of iterative process. Perfect, on point, Kenny, thank you. I mentioned earlier the 4 buckets of cost. I'm gonna go into a little bit more detail on that here. So this idea of wages is very simply put, this is your W-2 staff. These are expenses that you're incurring day to day for labor. And there's 3 categories of this. So we can claim R&D costs towards direct research. This is going to be a designer physically designing a new part, or a team member running a new line out on the floor. They're directly participating in R&D. There's also the idea of support and supervision. So we kind of call this the 1 step up and the 1 step down rule. So from the direct research, we can qualify direct support, which are going to be staff that are a machinist making a prototype part, right? a lab worker cleaning lab equipment, getting ready for an experiment. This could be some type of software tech charged or changing components for testing of a new widget. In a lot of cases, when you're manufacturing a new product, when it goes to the first run, maybe second, third, fourth, the team members out on the floor actually performing the runs are oftentimes supporting staff. A lot of times they're not involved in the design. Then there's the idea of supervision. So this is going to be one step up. This is going to be your managers, your engineers, in a lot of cases, maybe even your C-level executives who have ideation and conceptualization experience, actually leading the research effort. So when you put it all together, it's not just, I'm going to take the cost of the people running the line. You need to make sure you're also allocating for the people managing those individuals and the people supporting that effort. On the supply side, we're going to have raw materials. This is any raw material purchased and used up in the process of experimentation. A very good example of this would be just purchasing basic aluminum or some type of components for a test widget. All of those costs that you are buying and ultimately are putting into these prototypes, they're being run, and then you have to decide, does this work or not? And a lot of times they're scrapped, can be allocated and taken towards the R&D tax credit. And in some situations, these are pretty substantial. Consider how many times your business runs a prototype, or how many times you have to develop that really unique widget. You're using not only components from a raw material perspective, but you're also utilizing the components you need to run your equipment. The third bucket here, this is contract research. This is effectively third-party individuals that you're bringing in-house to assist with the R&D effort. There is a heightened level of review we have to perform here. So the IRS has indicated and subsequently doubled down on the fact that the research you're undertaking has to be risky. And so we do have to look at the contractual language of your contractors if you're paying them to make sure they qualify. They also have to be here in the US. The fourth bucket here, most manufacturers do not have this cost. It's effectively the cost of renting cloud space to develop software. So if you happen to be developing software, whether it's an app, maybe it's improvements to an SAP system, maybe you're integrating in a custom SAP system, this is going to be the cost of holding that code in the cloud.
And I guess just a couple of points to reiterate on that. I think you pretty much covered everything, Matt, but I just want to reiterate to the audience, the test runs necessary to bring a new product to market where you're not, you have not proven the feasibility of economically and from a technical standpoint of actually manufacturing that product. Again, the line personnel, quality engineers, manufacturing engineers, it's going to be a variety of different people. And with that, when you are talking about specialty equipment, your contract researchers are typically your contract vendors from that standpoint. And right, for example, that's very common is some kind of non-compete where the vendor that you're co-developing something with gives you a time to market of say like 3 years or 2 years that you have exclusive right to use that equipment. So those are the kinds of things that we look at when we're trying to evaluate, as well as the test runs themselves and the material wastage. I've had a lot of instances where my customers have spent hundreds of thousands and millions of dollars trying to bring something into the United States that otherwise is very difficult to automate. And they've made that investment and they've had a lot of waste on the floor. Those are the things you need to think about when we're talking about research credit.
Wonderful. Thank you, Susan. I think the added colors is absolutely necessary. Along those same lines, right, we've been talking thus far about what qualifies. It's almost more important to know what the IRS and the case law has effectively noted as disqualified. This is non-qualified or exclusions to the R&D tax credit. A few of these are pretty basic, high level. Foreign research is sort of a no-brainer. The R&D effort that you are undertaking has to be done in the US. The second kind of, this is a very large one, is this idea of funded research, which I hinted at earlier. This really only pertains to manufacturers who are developing other people's products, or you're some type of contract manufacturer, or a job shop, right? You're just developing a bunch of widgets for a customer. We do have to look at the contractual funding agreements and confirm that, one, you are undertaking the research effort at some form of risk, and two, we have to be able to prove that you retain the rights to what you are developing. Now, there's a lot of different variances there. It's a very technical area that has, at this point, 30+ court cases that help guide us. But this is something to be cognizant of. The third bullet here, I mentioned this earlier, but it's once a product is commercialized and is ready for commercial production, that's where research stops. And so the IRS doesn't want to reward taxpayers for just making the same widget over and over and over again. So once a product is ready, or once a line is ready to produce at volume, research has effectively ended. Duplication, this is effectively, you can't make the same part twice and take the credit on it twice. There has to be some form of change. Now, this is where that 4-part test comes into play. And an example we like to use is like a coffee mug, right? You can only make so many different iterations of a coffee mug. However, if you design a coffee mug that heats itself, that is an improvement upon an existing product, and duplication there would not come to play. From a software perspective, routine maintenance, but also from a production line perspective, shutting down the line, taking time to just maintain it is not going to rise to the level of research. Market surveys, but this is really marketing in general. So activities that could correlate to marketing or the improvement of a manufacturing process that are not rooted in technology or a hard science would fall under this market survey category. Research for style, taste, cosmetic, and seasonal. So these are sort of a heightened version of exclusions. This is really just saying that if you change the color of something, if you're making something aesthetically different, or whether it be for seasonal or not, it's not going to be research. If you make the same widget in 7 different colors, it's still the same widget. And then we mentioned software development earlier. It's very important that we focus on the development of software. Installing or integration of a purchased software. I'm sure many of you may use some form of an SAP or Salesforce even. These products are made to be very interchangeable now. We have to be able to prove that your team's actually developing something new. You can't just use a system for what it was intended to be designed for. Thank you, Kenny. This is probably something that everybody's been most excited about. So what is the credit, right? This far, we've talked about kind of what it is and how do you qualify, but how do we monetize that? The IRS has prescribed 2 different ways to calculate the credit. There's the regular research credit method. This is what we call the regular method. This requires a little bit more of a deep dive. This is where your consultant should work hand in hand with you and your CPA to establish, can we undertake this and actually calculate the research credit? Do we have the ability to go back and build what we call a historical base? Sometimes this only takes a few years worth of data. In other cases, this could take 20 or more years of data, tax returns and wage information, for example, to actually establish when you started doing R&D. Then there's the alternative simplified method. So this is slightly easier. You still have to build out that base component. There's still a hurdle of such that is created so that you can create that incremental filing. However, it only requires the prior 3 years. The reason we bring this up, and we see this a lot in the space, is your provider, whether it's your CPA or a specialized consultant like us, they should be calculating your credit both ways, or at least trying to. Failure to do that, I guarantee you're leaving money on the table. And a lot of providers just run in and do the alternative simplified method. And as you can see, there's a 6% difference at its face, but that oftentimes can turn into thousands of dollars that you're leaving on the table by simply not pursuing a separate method. in general, and this is important for everybody, if you're trying to calculate or estimate what your credit may be, it's usually a safe assumption to say that the credit is somewhere between 7 and 10% of your total qualified spend. So if we go back to those 4 buckets of cost, if you're kind of in your head estimating about how much you're spending on R&D, in general, around 10 or slightly under 10% of that spend is a safe estimate of what your credit may be. And then the last piece here for me, this is what we call the qualified small business credit, or the payroll offset. So I mentioned earlier that this is an income tax credit, and the goal is that this offsets your end of your tax liability. However, if you are a startup, if you are a smaller company that isn't making a lot of money, at least not yet, maybe you're just not paying tax for that year. So long as you are under your first 5 years of revenue, or you're under 5 million, or I'm sorry, and you're under 5 million in gross receipts, you may qualify for the QSB, or the payroll offset, which allows you to use the credit in its same capacity to offset your quarterly payroll taxes. So this can be very beneficial for smaller startup businesses and companies who are still newer and are taking losses maybe on paper. They can still leverage the credit to continue innovating, and it simply offsets your quarterly payroll taxes.
Thanks, Matt. So we're not going to go through all of these state incentive programs, but we did want to highlight a couple of common themes. What Matt walked through was the federal tax credit. A lot of the states actually offer a similar tax credit, and in general, they use the same rules, oftentimes just with a few tweaks. So for example, it may be the same qualifying criteria and the same qualified research expenses that you can include, but they'll change the credit percentage, or they may make some changes to what actually qualifies. California is a great example of a very important state level program. Oftentimes what we see is, it can potentially double the overall research credit value when you combine both federal and California. Connecticut is an example where the rate changes depending on the size of the business. Some states limit the credit to specific targeted industries, so perhaps life sciences or advanced manufacturing. In other states, you may have to actually apply for a portion of the credit. You can't just put it on your return. So a lot going on in the state space. If you're not currently claiming the federal credit because you're not in a cash tax position, you might still benefit from a state level credit, and vice versa. If you are claiming the federal credit, you definitely want to be looking at the state level as well. With that, we'll turn to our next polling question, which is a simple yes or no. Do you currently use an outside provider to calculate the R&D credit? All right, looks like it's roughly a third for each answer. Yes, no, and unsure. So that's helpful. It looks like in our experience, we see about the same mix of companies that are doing it in-house and those that use an outside consultant. Now we'll turn to a discussion of what transpired last year in Congress. So if you've heard of the term OBBB or OBBBA, that relates to the One Big Beautiful Act that Congress passed last year and included a number of tax provisions. The most important one for our conversation is that Congress, after a 3-year period, has decided to change the rules for Section 174 amortization. If you recall, prior to 2022, when you incurred a R&D expense, you could immediately deduct it. And then starting in 2022, you actually had to amortize it over 5 years. And in year one, you got to deduct only 10% of that. And we always were assuming Congress would fix this, but it took them a while to do it. So last summer, they did finally make that change. And for large companies, the change will be on a go-forward basis. For smaller companies, those that have less than 31 million in gross receipts, there actually is a retroactive opportunity. So we've been talking about the Section 41 R&D tax credit so far. Section 174 is a separate provision that provides the deduction for R&D expenses. But the two are related in the sense that the changes to Section 174 increase the economic value of the credit based on the way that the two sections interact. So for smaller businesses with less than 31 million in average gross receipts, you can go back and amend your returns back to 2022 to accelerate the deductions that you haven't been able to claim so far. So this provides an immediate cash opportunity. And at the same time, as you go back and amend for Section 174 deductions, you can look to see if you've missed any R&D credits. What we found over the last couple of years is that the Section 174 change put a downward pressure on R&D spend. A lot of companies, because they couldn't get the immediate deduction, decided to reduce their R&D spend. And that's a problem for the R&D credit, because if you'll recall from Matt's presentation, the credit is based on incremental R&D spend over a baseline period. So now that companies will be able to immediately deduct, we do anticipate that more companies will invest even greater amounts in R&D, which will increase the R&D credit opportunity, both for the last couple of years for small businesses on a go-forward basis for larger companies. The key point I would make here is Congress gave a limited amount of time to make a decision on whether you'll amend the returns for 22, 23, and 24. So you'll be wanting to work with your tax preparers or CPAs to determine what makes the most sense for your business, with July 6th, 2026 being the deadline. There's also a couple of administrative changes that have happened. If you'll recall, the IRS was posturing over the last couple of years to require more information on the original return with regard to an R&D credit claim. They've decided to continue to make that optional for tax year 2025. So instead of having all the details on the original return, you still need to have all of that information ready and available in the event of an audit, but you don't necessarily have to put it on the return for this year if you don't want to. On amended returns, the IRS does require you to submit quite a bit of information detailing the business components and the qualifying research expenditures. And to the extent you don't provide it with the amended return, you will have a transition period. You'll get a letter from the IRS with a 45-day period to cure the return. And that guidance is in effect through January of next year. And they've extended this transition period for a number of years. We'll have to monitor over the course of this calendar year if they'll extend it again. But just know that for amended returns, there is a heightened standard of review. With that, I'd like to turn it over to Susan to walk through a couple of real-world examples. She's, as the introduction alluded to, she's got 35 years of experience in this space, and not just in calculating the credits, but also defending the work before the IRS with pre-filing agreements, and as an expert witness in some of the most important R&D credit cases out there. So Susan, I'll turn it over to you to give us a kind of a high-level overview of different areas and then walk through some examples from the regulations and court cases.
Thanks, Tim. So I'm going to go through this pretty quickly, but I definitely want to make some key points, and I'm going to provide some real world examples just to allow those of you who are more attached to the floor, more involved in engineering and in manufacturing, to kind of think through it, how it might apply to your business. So the first thing you think about when you talk about manufacturing R&D, which typically, frankly, is as much as what we see up through the product development phase, if not more. The first thing you think of is developing new or improved production processes. Think about what's been happening in the world. Let's say you're an adhesive manufacturer or you use plastic. In adhesive manufacture, one of the big trends has been trying to introduce natural ingredients, lower cost ingredients such as starch for latex, things like that. What does that do? That usually introduces a real uncertainty as to manufacturability. You might have fouling, gunking, you might have buildup. Let's talk about developing new products, equipment, or tooling. Let's say that you've traditionally manufactured products that are steel or harder metals, but because you have a customer who has a very specific requirement that requires a lighter weight material that is not quite as strong, but highly subject to deformation, such as aluminum. That's where you might have a lot of tooling, like specialty punches for aluminum, specialty products manufactured in aluminum. That's just a couple of examples. So, the developing new products for customers or new tooling to make those products is what I want you to focus on. Developing prototypes for internal sale. This is a huge issue. It's near and dear to my heart because of the court cases that I was on. But if you are uncertain as to whether or not you can make a product for a customer that you perceive because it is a huge market opportunity to you, and you must build it in order to sell it to the customer, because typically that's how you try to defray your cost. You try to line up a customer and say, if we do it, are you going to buy it? Even if you sell that prototype, that can qualify if you meet the four-part test. Software development and controls. A big issue a lot of people are not thinking about is the use of vision systems for quality inspection. And what they're finding is it is very, very difficult to accumulate and sort through and sift the massive amount of information that they're getting from the sensors and vision systems that they have in place to be able to provide meaningful feedback for the inspection to actually occur and replace a human operator. So those are the kinds of things that I'm seeing very consistently. So in order to do that, and also just kind of to allay the fears of my engineers, because when I work with companies, I typically am working directly with the head of engineering and the head of manufacturing. I like to walk through real life examples where the IRS has said this is qualified research. And the first example, I think, is really kind of key. It's very simplistic, but it's kind of key to understand what they're talking about when they say what is qualified research in the production area. In this particular case, they're outlining in the regulations themselves a situation about a taxpayer, and let's say they're a cheese manufacturer. They're trying to come up with a fine shredded version of cheese versus large shredded version of cheese. But in order to do that, while they can buy a cutting blade assembly off the shelf or pretty close to off the shelf without modification, they cannot use their existing shredding blade. And the reason is they've got to have a thinner, stronger, because thinness and strongness don't go together. The thinner something is, typically the less strong it is. So there's those conflicts or those design conflicts. And so in this case, and under the regs, they were able to analyze various blade designs and they came up with a final blade design. That was qualified research. That is what's in the regulations themselves, which is the highest possible authority. If you go to the next slide, there's an example of a mold manufacturer that was providing molds to a automotive manufacturer. The automotive manufacturer has a mold. Somebody else has developed a mold for them, but they have to further adapt it to produce the necessary component. That adaptation otherwise met the four-part test, meaning it wasn't it met the uncertainty test, it met the process experimentation test, and the court ruled that yes, the purchase of third-party molds and the modification of such that otherwise met the definition of qualified research was in fact qualified research and were supplies. So again, that is something that people should be thinking about. Even if you're working with a OEM, they may provide you something and then you have to substantially modify it or further modify it in order for it to make it work. And then the third example I like to go through with engineers is the Trinity Industries case, which talks about Trinity Industries. Most people know them as a rail car manufacturer. They actually build boats. We lost all the records so that we didn't have the documentation that we would typically like to have when I supported the attorneys in this. But what we were able to prove is that several of those boats were so significantly complex that there was uncertainty as to whether they would meet the customer's requirements until actual acceptance testing by the customer took place. And that is, I think, very important to illustrate the sold prototypes. I often see this in the automotive industry where you have to produce manufacturing prototypes. You have to produce prototypes as your product is actually maturing. You have to make sure that it's viable from a manufacturing perspective because its basic economic and functional requirements is the litmus test. And until you meet that, you are good to go. Qualified research only stops when you've met your basic economic and functional requirements. So sold prototypes is a big issue because you have the risk until you can prove that it works for your customer. And with that, I will turn it back over.
Thank you, Susan. Super helpful to get some real world examples, especially from you having been on the accounts that worked on those calculations. This is our third and final polling question. Based on the examples in the presentation so far, do you believe you're capturing all available R&D tax credits? And the options are yes, we've identified all qualifying R&D activities. Maybe we may have overlooked some activities or expenses. No, we need to review our activities and expenses in more detail. Or D, unsure. Great. So it looks like perhaps the examples in the presentation perhaps illuminated some areas where there might be additional opportunity. So with that, we'd like to spend just a couple minutes outlining what our process is at Sagemont and also how to substantiate your claim and what the best practices are in that area. So at Sagemont, we like to think about the R&D credit in phases. Phase one is really a feasibility study, which helps us understand what qualifying activities and expenses there might be, whether the credit is material, and third, what the level of effort would be, both on our end and for the company. Oftentimes, a lot of companies qualify for R&D, but they have higher priorities, or the substantiation isn't there, and so the level of effort to go back and recreate files might be too onerous. So the feasibility study, we're gathering tax returns for the past few years, profit and loss statements, some project descriptions, employee wages, and from there we can understand what the potential value is. We'll outline what the process for substantiating QREs is, and what we would need to calculate the credit, and then work with you to make sure we understand what your deadlines are. If you're a calendar year taxpayer and you want to get it on your original return, that looks different than if you're going to extend or file amended returns. But the point is that we don't want to do a deep dive calculation before we understand that it's a material opportunity for you and that we have a plan in place to make sure we can capture and sustain the credit. Phases 2 and 3 then are really the more detailed work. Once you've agreed to move into that second phase, we're capturing more historical business records, working to identify and describe the business components, interviewing key stakeholders to make sure we're understanding how much of the employees' time is dedicated to research, not just the employees that might be directly working on research, but if you'll recall, also the direct support and the direct supervision. And then ultimately preparing a pro forma 6765, which is the IRS form that details all of the qualifying expenses in the credit amount, and working with your CPA or tax preparer to make sure everyone's on the same page. So Matt, with that, I'll turn it over to you to talk briefly about substantiating your R&D claim.
You got it. Yeah, so we mentioned earlier, and it's come up a few times, I guess, during the webinar, that the substantiation seems to be this great connector here, and it really is. So every year, new court cases come out that guide us on how we conduct these studies, what we should be claiming, what we shouldn't, and every year the IRS gets seemingly a little bit more concerned with the ability of taxpayers to substantiate their claims with documentation. And so it's very, very important that we're linking create a narrative format saying my team is doing X, Y, or Z. It qualifies and meets the 4-part test. We still have to do that, of course, but the court cases of the last 3 years have really pointed to this idea of, that's great, we love the narratives, we need you to connect the narratives to substantiation.
I think we might be losing Matt there. So just to walk through a couple of these quickly, and then Susan, I'd love to get your thoughts. Documentation is really important. Contemporaneous documentation being the gold standard. Tracking QREs, whether it's the payroll files.
It can be design documents, this can be PowerPoints, this can be pictures, emails. We should have the technical thing contemporaneously and come up with experience with.
So I think
sorry,
really,
Tim, I'm cutting out there, but the key points. Oh, go ahead.
Well, I was just going to say that the great thing is, before we go to the next slide, because I think Matt, for some reason, I think your audio is a little bit tricky. The key thing is to remember that your engineers keep documentation. They're kind of known for that. And so they probably already are sitting on everything you need to prove the study. So with that, maybe we should go to the next slide and kind of talk through that a little bit. So choosing the right R&D tax credit provider, if we go to the next slide, one of the things that is really key and critical, and I'm doing Matt's piece just simply because he's having audio issues, but one of the key and critical things is if you don't have contemporaneous documentation, if you are doing high-level estimates, I always make this joke. I used to head up the engineering construction industry group for tax for my firm for 17 years. And I was reviewing a study. We were the auditors, and I was reviewing a study, and I was trying to talk through to the CFO, what was inherent in the study. And I asked him, I said, hey, Bob, what do you do that's qualified? He goes, what do you mean? I'm the CFO. I don't do anything qualified. I'm an accountant. He's like, I'm like, well, you're claimed at 15%. So those kinds of things really ruin your credibility if the credit is reviewed from a state or from federal perspective. Again, no documentation, limited understanding of what the actual law is. And so those are the kinds of things that you really need to focus on when you're trying to choose a provider. That provider needs to have a clear defensible methodology. And they need to stand behind their work. So if you're getting a deliverable that doesn't conform with what the IRS has said they need, then that's a problem. And I don't know if you've been able to work out your audio issues, Matt, if you want to chime in on that.
I can certainly try. Please jump in here and cut me off if it gets choppy again. But to Susan's point, these red flags are becoming more and more prominent. The court cases are being more strict. There's more questionable players out there providing questionable advice, and so it is very, very important that you connect with your CPA and come up with a plan to claim and calculate these credits on an ongoing basis, but also a plan to help decide who your consultant will be. I think we can probably move on to the next slide there, Kenny. I think we're a little behind. Yeah.
Great. So I think just reiterating the fact that you're going to want someone to be available in the event of an audit, and not recreating the R&D study at the point that you get audited. A lot of times people leave companies, and so if you had someone doing R&D and you get audited 3 years later, but that person's no longer there, it can be really hard to substantiate it. So working with a firm that understands the rules, will provide the calculations and the R&D study upon delivery of the package to your CPA is critical. Using technology where possible to make it faster. Ideally, you're understanding what the potential value is. You're also assessing the strength of the documentation, and then you're always keeping this compliance mindset with an audit-ready deliverable in hand, so that everyone's comfortable with the work product and your ability to present to an auditor. One thing that we do love to do is to bring an engineer, in at the end to review the R&D study to make sure that we don't have situations like Susan mentioned, where the CEO or somebody is included without really knowing that their time and expenses have been part of the calculation. So with that, I think we have about 7 minutes left. We'll open it up to Q&A.
Great, thanks everyone. Thank you to the Sagemont team for that informative webinar. If the audience has any questions, please enter them into the question box now. We do have the first question ready to go, which is, how is the process designed to reduce the time spent by our researchers and engineers?
That's a great question. So when we think about our phased approach, we like to make sure it's a material opportunity and identify who the potential stakeholders are in that phase one approach before we spend a ton of time asking engineers and the manufacturing support to spend their time working on our project. I've worked on clients before where very large numbers of people were involved in the R&D process, and there wasn't a good plan in place with the previous vendor to capture all of their time, and the engineers are busy people. And so we want to, in that phase one, make sure everyone's on the same page, that there is material value. It's important for the company, and identifying who the stakeholders are that we need to talk with, and then develop a streamlined process and survey approach to make sure that we're capturing the value without impeding the important work that the engineering and manufacturing support teams are doing.
And what I would add to that is that the manufacturing operations typically have very good record keeping about who's on the line or what the cost of line personnel is, what are the costs of supervising manufacturing engineers, what are test runs, what runs are being done for product development purposes, what runs are being done for process development purposes. So when you're talking about picking up just the what I consider to be the easy pickings, those are usually embedded in your manufacturing traceability software, and we can pull that relatively easily.
Great, thank you. The next question that came in is, I may have missed this, but what is your success rate at finding tax credits for companies? And is there a particular size company that this works best for?
Matt, do you want to cover kind of your experience in the R&D space? I know you alluded to it earlier that in the manufacturing space, most manufacturers are doing R&D, but it would be helpful to hear from you in terms of the typical size of of the companies that generate a meaningful R&D credit value.
Yeah, of course. And to sort of echo that, I think the success rate, I mean, it's as close to 100% as you can probably get, right? I mean, very, very few companies are just not doing R&D, at least once they thoroughly vet that internally and then have conversations with us. In terms of size, it really does span the gambit. We've worked with over the thousands, multiple thousands of studies we've done. We've worked with small $1 million companies who are just starting up, who have several $100,000 in R&D credit because they're spending so much money on new products and widgets. Then you also have the $100 million, $1 billion companies that Susan and Tim and I have also worked on. And those studies are much more complex. There's so much more technicality to those and time investment, but the credits are massive. And there's really no gauge. Something that we do during phase 1 is we try to pinpoint the R&D activity fairly quickly, but we also try to dig into what that size will look like and does it make sense for you from a tax perspective before we get too far into the process.
And I think just real quickly, it does matter if you can use the credit. You may generate a very large credit, but you might not be in a cash tax position. It's important to remember for the smaller companies, the startups can use the payroll credit option. If you're a larger company, you can carry forward the credit for up to 20 years. So if you anticipate that you will be profitable in a few years, that's also important. That's the importance of the phase 1 review. We're looking at tax returns to make sure you can monetize it. So just because you're a really large company doesn't mean that you'll get immediate value, and just because you're a small one doesn't mean that you won't have anything. But we'll work with you in that phase 1 approach to make sure everyone's on the same page about the ability to use it and that it's material.
Yep.
Great, thank you. Next question is, what is the biggest mistake you see businesses make when claiming the credit?
Matt, that sounds like a question for you, then I'd love to get Susan's perspective as well.
Yeah, no, I think especially, and I've mentioned this a few times in the webinar, especially the last few years, it's sort of blindly claiming the credit by allocating either just general numbers or general percentages to buckets. It's the idea of not substantiating and actually going through the study process. Several of the most recent court cases have really hammered companies, unfortunately, because of that exact thing. So my answer is substantiation is always going to keep you out of trouble, and then actually thoroughly vetting those costs. I think Susan probably has some experience she can add to that as well.
I would say the biggest mistake that I see, and I alluded to this, is not having the head of manufacturing engineering, or product development actually be involved up front to kind of outline what the process development process is and product development process and who to go to for records. And then at the end, also kind of do a high level evaluation of what came back, because typically, as I said, engineers have numbers in their mind and they're pretty good about it. And using them as that final check is a really good way to make sure you've got the right records and you've got the right numbers, and to make sure everybody's on the same page. And it doesn't take very much time.
Great, thank you. We had another one. I thought the information about the law that changed in 2025 and allows a claim back for a certain period of time with a deadline of July 2026 was interesting, but I missed the details. Can you reiterate that point?
Yes. So for companies that have less than 31 million in average gross receipts, the change to Section 174 allows you to go back and amend the returns for 2022, 23, and 24 to accelerate the deductions for the piece that you haven't already claimed on those returns. If that gets you to a bad answer, you can actually, the amounts that you haven't already deducted, you can split between 2025 and 2026, but it's really important that you're working with your CPA or tax preparer to understand how that modification to Section 174 and the retroactive opportunity plays with your facts and circumstances. But you need to have that conversation sooner rather than later because you do have that July 6th deadline in order to make that election. And then on a go forward basis, let's talk about 2026 and beyond, you will be able to deduct 100% of your R&D expenses in the year they're incurred without having to amortize those.
Great, thank you. Well, that concludes all of the questions submitted today. Thank you to the Sagemont team for a very informative and engaging session, and thank you to our association members for joining us. Tomorrow, you will receive a follow-up email with a recording of today's webinar, along with a brief survey to share your feedback, as well as contact information for the presenters today with Sagemont. Thank you again for attending CM Services' first ever webinar for manufacturer members across our client partner associations. We hope you found today's session valuable and look forward to having you join us for future webinars. Thanks, everyone.
Thanks, everyone.